Hello and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today is Fundamentals Friday, so we look at the fundamental shifts within the industry, what's moving markets, and what to watch out for. Let me quickly share my screen to give you a little bit more background on what I'm talking about. Two core headlines here that I'd love to discuss. Number one is Zenita reports or highlights that shippers should now get on with contracting, i.e. Locking in the low contract rates for the future and stop relying so heavily on spot rates or buying on the spot markets. Why is that? They argue that spot rates or contract rates now have bottomed out because spot rates started to increase above contract rates on many trade lanes already. And usually there's a time lag after which contract rates follow spot rates, and hence an increase would be expected. And also they maintain that GRIs in the near past, so to speak, have held relatively firm, so that August rates are now actually above July rates. And with that, they postulate that it's time to move on. It's time to lock in these low contract rates and agree on volume commitments for the next months, quarters, and year. But we maintain that there is still no significant sign of a demand uptick. Quite on the contrary, I've just read an interesting article that major US retailers are now returning to just-in-time supply chain versus the just-in-case supply chain. And with that, there would be no sort of significant demand uptick following a inventory destocking, because retailers could just maintain lower inventories going forward. And number two, after the demand side, we always look at the supply side. There is still the capacity influx coming. 30% of the global fleet is on order books and will come onto the market. And as these are mainly larger vessels, or on average larger vessels, this will increase the size across all trade lanes as these larger vessels actually cascade down through trade lanes throughout the regions and displace smaller vessels. And then the second core headline that I'd love to highlight and quickly discuss is we had our Exchange Customer Roundtable yesterday, and there was an interesting discussion around container prices versus leasing prices. And participants saw very interesting purchasing opportunities across the globe as for two reasons. And number one, used container prices are now close to, or at least close to scrap value, so that if you buy containers, your fleet has a built-in sort of stop loss because the price will not fall below scrap value. And number one is leasing rates are at the moment really not competitive due to increasing interest rates. So leasing companies do need to command a higher per diem rate because they have their financing obligations, and they need to maintain a certain income level to satisfy these increased interest rates. Cool. Two, I guess, very interesting discussions for you to also think about over the weekend. I, for my part, will certainly do that, take the weekend to ponder. On that note, we have our Digital Container Summit coming up in mid of September, so 13th and 14th of September. If you haven't signed up yet, please head to containerexchange.com and then follow the signs to the DCS. I think that forum really is a good place to discuss these trends and, of course, other factors impacting the container industry. That's it for me. Thanks all. Have a good weekend and see you all on Monday. Take care.